Seeing what I'm seeing?
Yep, it looks good. All right. Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the December 2023 First Friday webinar. Today's presentation is titled First Things First, How to Invest Amidst Uncertainty. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is what is the market missing? If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking the icon at the bottom of the screen. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the December 2023 First Friday meeting for all of our family office members. As you probably know, this is the last First Friday meeting of 2023, of course, and we've now had 15 First Friday webinars, and all of them are available on our website if you'd like to go back and see how we've interpreted the economic signals while doing our best to cancel the noise. Our goal has been to help our family office members make intelligent decisions by ignoring the noise with little predictive power and focusing on the signals with the highest probability of telling us what is to come. If you remember, we started these First Friday meetings in October 2022 because we saw storm clouds on the horizon. The U.S. Federal Reserve was fighting a bout of inflation, which turned out to be stickier than originally thought and they were using increasing interest rates and decreasing liquidity in the economy. History tells us that there was an 80% probability of the Fed over-tightening and eventually sending us into a recession. And while recessions are events intelligent investors would like to avoid, current conditions heightened our concerns, and here's why. Our U.S. debt has increased by over $20 trillion over the last 40 years. That's 10 times the debt it took our country over 200 years to amass, and most of it accumulated in the last 15 years. History shows, and you and I have, each of us have discussed this with each other, debt magnifies economic outcomes, both good and bad. This means the probabilities of a severe recession have increased while the capital markets remain overvalued and speculation is abundant. So this confluence of negative events gives us concern. This is the reasoning behind starting these webinars. And as we said, our goal was to call your attention to the data separating signals from noise and to prepare all of our families for what lies before us. So, as I had said, in 2022, the U.S. Federal Reserve was draining liquidity from the U.S. economy, which usually means recession. This continues today. The data tell us the U.S. will enter a recession in the first half of 2024 or sooner. Make note, recessions don't have to be significantly negative. However, during recessionary periods, corporate earnings tend to decline by an average of approximately 20%. And when earnings decline, asset prices decline. Since our asset prices were already 2 standard deviations above normal, we thought it would be valuable to ensure that all the families we serve understand and prepare for the potentially negative risks ahead. Doesn't mean that it's going to happen. It just means be prepared. In the last 15 First Friday meetings, we focused on the Federal Reserve's intention to overcome inflation by reducing available money in our economy. In 11 of the last 14 inflation wars, the Fed sent our economy into a recession, meaning this is typical and it's to be expected. However, there's a problem today. During the last bout of inflation, we had less than $1 trillion in debt. So that means during the 2007 to 2009 recession, we had less than $1 trillion in debt. Today, we have over 30 trillion in debt. The risks today are overwhelmingly negative. We've also repeatedly discussed the fact that all 3 of the most important leading indicators show that our economy is slowing. The odds are very high that our economy will enter a recession over the next year or so or sooner, as we'd said earlier. Today, we're going to discuss what the data suggest will take place over the next 12 months and the strategies we believe allow investors to avoid most of the risks and uncertainties which are likely to confront us all over the next year, while still participating in the global market, which is structurally sound over the long term. So before we start, let's discuss the elephants in the room, because this is the background information that's really important. Over the next few years, the US economy and the world will have to come to grips with some very important issues. And I promise you, I'm not trying to be melodramatic, but if these issues aren't solved, they could truly change the world as we know it. 2 of the issues staring us right in the face are our economy. This chart shows the data which document the US spending for more than the last 50 years. The yellow line under 0 represents deficit spending. The yellow line over 0 in the late 1990s represents our only surplus in over 50 years. This slide simply highlights the magnitude of the recent deficit spending, totaling nearly $2 trillion in 2023. That's $2 trillion overspending in one single year. This slide clearly shows it took us 200 years to amass our first trillion in overspending. And similar to a drug addict, our politicians couldn't get enough of the money drug. They increased our debt by 12 trillion over the next 30 years. And again, over the last 15 years, they doubled our debt by another 12 trillion. The US spending at this rate is unsustainable. Our debt levels are unsustainable. And you might ask, why? The answer is that our interest payments on our debt alone is approaching $1 trillion per year. And as said, this is mathematically unsustainable. And to make matters worse, I promise you, we have no plans to stop this spending. Make no mistake, there's no free lunch. Correcting this overspending parallels a medical doctor's dilemma when advising a drug-addicted patient. The doctor's orders are to the patient, you must cure your addiction or you're going to die. Curing the US addiction to overspending will involve change, and this change will be incredibly uncomfortable for the citizens of the United States. I can promise you this. This slide shows inflation at roughly 4% today. While it's quite likely that inflation will continue to move lower, which is good news, it's as likely as not that it may take longer than the market expects to reach our 2% goal. Here's one possible reason. The world is becoming bifurcated into an Eastern leaning alliance and a Western leaning alliance. This is forcing restructuring of all of our supply chains and for critical services for almost every country on the planet Earth. It really means either finding new friendly sources formerly produced by low-cost producers, which, by the way, took the United States almost 40 years to establish and refine, or it means producing our most important goods and services at home. Either solution means higher costs for goods and services. So each of us should be aware that higher costs are likely for almost everything in our future. Understanding that there are more risks than we have time to discuss today, and that most of the risks will not come true, let's discuss allocating a portfolio with what we know. So here's what we know. We'd like to share what we consider to be our base case for the next year or two and how we've prepared our portfolios for the level of uncertainty in front of us. Keep in mind, as the data change, our expectations for the future may change, yet we'll keep you up to date with each data change. Here's how we attack this challenge. First, let's list what we know, or let's list what we think we know to be true. Next, our approach is to start with the top down. It's called macroeconomic, or it's called the macroeconomic approach to portfolio allocation. Well, what we want to do is create what we call a base case, or what we call the highest probability case for each portion of our investment allocation. Here's some of our current thinking. First, we want to understand what our economy looks like. Currently, the US Fed is tightening. Leading indicators point to a recession, yet the current status of our economy is healthy. It's just as good as it can be. The most likely future path is a recession. Our base case is that it will be mild because of the money that the fiscal administration has pumped into our system. Yet a hard landing or a heavy recession is possible due to the domino effects of our current debt. If it gets that far, we really could get into trouble. Next, let's look at how the capital markets are set up. We include both stocks and bonds. So, what's the stock market telling us? The stock market is clearly overvalued. The current price earnings multiple is 20 times earnings, with the historical average of 15 times earnings. The most likely future path is reversion to the mean of 15 times earnings, meaning that's likely lower or significantly lower. There's a couple of ways to get there. The stock market, or before the stock market starts to grow again, either valuations will have to come down between 20% and 40%, or earnings will have to grow by 20 to 40%. One thing or the other is likely to happen. This could become a reality if the stock market corrects itself by lowering valuations by, as said, the 20 to 40%, or what we believe is a very real possibility, we could tread water at current valuations for the next few years while corporate America becomes more profitable and earnings catch up to current valuations by growing 20 to 40%. Said a little bit differently, either current valuations decline or we endure a few years of lots of volatility, little or no gains, while earnings catch up to the earning to current prices. My point here is that history is littered with both corrections of 20 to 50% or more, with periods of 5 to 10 and with periods of 5 to 10 years where increased volatility of the stock market's ups and downs ended in 0% appreciation. We would like to avoid both of these outcomes. Next, we look at the bond market. Of course, the bond market's largely manipulated by the US Federal Reserve, which means we're guessing at what the US Federal Reserve will do next. Our view is that the most likely future path for bond yields is lower, which means that bond prices will be higher. As bonds increase in value, bond yields go lower. The reasoning here is that we believe our inflation will slowly recede. This will give the Fed the ability to lower rates in an attempt to keep our economy out of recession. If we're wrong and the inflation rate does not recede or stay stickier for longer than we think, the current interest rate levels will likely send our economy into a recession, or something in our economy will break. Some portion of our economy will fail. This will force our US Federal Reserve to lower rates in an attempt to rescue the economy. So either way, we think the Fed is going to have to lower rates at some point in the future. This means that bonds are likely to become more valuable than the current market prices. The global macroeconomic environment today is likely to play a more important role in our investment allocation than at any time since the 1980s Cold War. Today, we have wars on two continents. While we believe the most likely future path is for peaceful solutions, the outcome is truly unknown. This uncertainty calls for a much more conservative or defensive investment allocation. If these wars become more global, it is a real problem, and it's a mess currently. So, what do we think we know? The stock market's overvalued. The Federal Reserve is trying to slow our economy, and they will be successful, which will likely lower stock valuations more than normal. Our bond market is offering yields which are reasonably attractive relative to inflation for the first time in nearly 20 years. And the geopolitical environment offers a higher level of danger than normal, which also suggests a more conservative investment allocation. Next, it's important to find out what we need to know before we determine how to allocate your investments in a manner that is most likely to achieve your needed goals. So firstly, or what we need to know are the goals of each family or foundation in charge of investing assets. So the risk levels must be specifically defined. So this means defining the volatility that you're comfortable with. It means defining the variability of possible losses over time, because losses tend to make people act emotionally. We must also define the investment time frame. Specified in years is fine. Usually, this time frame is based on life expectancy. We also need to know the current best guess for inflation, the current inflation rate, and the best estimates for future inflation. This is because inflation defines the minimum investment demands for almost every family. Finally, we want to wrap up all of the information so far and define our return goals. A family's return goals are dependent on a combination of risk tolerance and expected inflation, as discussed earlier. It's very important to determine and to understand the returns which are needed as opposed to the returns desired. The needed returns are based on your lifestyle and your asset levels, and they offer differ from your desired returns. So we wanted to share some of the asset classes which might be among the first considerations if our outlook becomes a reality. First, uncertainty demands intelligent diversification. Diversification, when built intelligently, tends to lower your risk and smooth out the ups and downs during significantly uncertain periods, and it tends to deliver average returns. So diversification truly is your first goal. Next, intelligent investment allocation during uncertain times includes the safety of either investment grade bonds, government bonds, and for those who are interested in a slightly higher level of safety than the stock market, business development companies or private debt. Real estate also tends to offer a slightly safer alternative to the stock market. So over time, real estate provides income of roughly 5% or so, with the asset base that tends to appreciate with inflation. So as we all know, real estate tends to inflate or appreciate with the rate of inflation. And that's averaged about 3.5% per year for the past 100 years. So real estate most often delivers two dimensions of returns by combining current income with consistent inflation in the underlying asset. Most of the families participating in this call own significant portions of real estate. Over the long term, we believe real estate offers more safety than the stock market, with higher current income and a base level appreciation which tends to keep up with inflation. Finally, if your investment plan includes publicly traded equities, stocks, which almost everyone on this call owns, the weighting should be tending towards value-based companies paying and increasing dividends that are high quality. These types of companies tend to offer investors lower volatility with more consistent returns, and these types of companies tend to rebound faster than more speculative growth companies. This chart clearly supports the tactical demand that includes dividends by showing the amount of investment return provided by dividends over the last 60 years. Another way to look at this chart is to remove the amount of return in blue and determine the total return you've received without dividends. In short, just equity investors should always require a dividend being paid with their equity investment. Buffett would tell you the same thing. Either way, as I said, I believe you can understand the reasons Warren Buffett has stuck to companies which pay dividends as his core philosophy for the past 50 plus years. This chart shows dividend combination and total return in a different scale. It clearly supports dividends as a major contributor to total returns over time. The returns in blue represent the total returns dividend investors received from 1960 through 2022. The line in gray represents the total return investors would have received if they did not collect or reinvest their dividends. The bottom line is that dividends provide regular income. They categorize companies that can actually pay dividends as high quality companies, and they provide completely passive income, meaning, you as the investor you have no work involved in receiving the dividends. And most importantly, dividends or dividend paying companies tend to increase their dividends faster than inflation, so investors don't fall far behind. With that said, let me ask Marissa if there are any other questions from the audience that we have today.
Yes, there is one question from an attendee. Their question is, what is a business development company and how do they compare to the bond market and to the stock market in terms of risk?
Okay. Thanks, Marissa. That's really a good question. They're not well covered in the market. It's an asset class I should have spent some more time on. So business development companies, or BDCs as we call them, is the acronym. They're less risky than the stock market because they largely invest in the debt market. They largely invest in debt securities, not equity securities. We all need to remember that stocks offer either no dividends or voluntary dividends based on the board's approval. Bonds, on the other hand, are contractual. They are a legal document. As I said, they are a legal contract which the borrower must abide by. In short, the borrower must live up to the covenants defined in the contract. Interest payments and debt repayments are not voluntary. As I said, they're contractual. So BDCs are less risky than public stocks. However, most BDCs do tend to lend money to smaller companies and to private companies. In our opinion, this is why BDCs are more risky than investment-grade bonds and government bonds, yet they're less risky than publicly traded stocks. They've been around for more than 25 years, and BDCs are going to fluctuate with the overall stock market because the market's mood moves everything, their current prices everywhere. Yet the dividend payments will fluctuate less often, and they tend to depreciate. These companies called BDCs, they tend to depreciate less than the stock market in a downturn, and they bounce back a bit faster than the stock market during a recovery. So I hope this truncated description helps you understand the basic differences between a stock and a business development company, or a BDC. It's really a good question, and it's a good question because many firms don't cover this security. If there are more questions on this type of security, please give me a call and we can discuss it in greater detail because it's not a well-researched portion of the market. Marissa, are there any more questions from the audience?
No, there are no more questions from the audience.
Okay, great. So to all, this will end our December First Friday meeting. And let me just say, please please know that we at the Abernathy Group Family Office are wishing each family a most interesting year to come in 2024. And we pray it's filled with as many positive surprises as you can stand. With that said, we'll see you next month.